Is the Bitcoin bottom in? A rare signal just flashed, and it only shows up in moments the market remembers for years. Bitcoin just went through one of those moves that hit you right in the chest from the high around $126,000 in early October down to about $80,000 in just 6 weeks. A drop of about 36%. That move is the biggest correction off an all-time high in the last 3 years. ETF flows flipped negative. Sentiment collapsed. Extreme fear took over almost every feed. If you have felt that sting when you open your portfolio this week, man, I get it. You're not alone. That feeling, it is real, it is visceral, and it affects you. I hear you. The question everyone keeps asking is simple. Did we just watch the top? Or is this part of the cycle where everything feels wrong right before the bigger wave hits? Today, I want to zoom out together. I want to show you where this drop sits in Bitcoin's history, what the liquidity cycle is setting up behind the scenes, and why a quiet change in stablecoin regulation may end up shaping the next decade of global finance. By the end of this video, you are going to understand why this moment feels so heavy and why the data tells a different story. All right, ladies and gentlemen, if you're ready for a very informed show and you're excited for it, do me a favor, destroy that like button. And again, remember, nothing in this video is financial advice. It's for educational purposes only. And let's get into it. The easiest way to calm your mind during a move like this is to look at the numbers. At the low around 80,000, Bitcoin fell about 36% from the recent all-time high near 126,000. That correction has lasted for 46 days so far, from October 6th through November 21st, where Bitcoin finally bounced in the low 80s. Take a look, guys, at this chart because it tells the real story. When people hear worst month since 2022, it sounds like something broke. When you pull up Bitcoin's full drawdown history, you see something very different. Moves like this show up all the time. Some corrections were even bigger, and they appeared during bull runs also. There were drops of 50% or more that later turned into multi-100% rallies. Charlie Bilioz measured the past cycles and found that each major correction eventually pushed to new all-time highs, including recoveries of 300%, 500%, and even more over the following years. So here is a simple takeaway. A 36% correction feels brutal in the moment. In Bitcoin's long-term pattern, this move sits inside the normal rhythm of the asset. I know the numbers look heavy. I know the candles look violent. The cycle has played this tune many times before, and the rebound that has followed has always been larger than the fear that came before it. Because I've been through every single big pullback since 2013, and it's always uncomfortable to watch and feel. But I'll tell you from someone who's been watching these things for almost, 13 years? You get used to it after a while and still never feels comfortable really, but you understand. The part is that you can separate your emotional feeling and looking at your portfolio from zooming out and saying, reminding yourself that, oh yeah, this is all part of the rhythm. This is what happens. I think the more important thing to look at here though is this pullback. What is it? Is it the end of a 4-year cycle? Or is it just a drawdown that we've seen so many times before in the middle of a bull run? Okay, guys, let's switch gears and talk about how the market felt during this drop. You guys probably know because you probably felt it too, but because numbers tell one part of the story and emotion tells the other, when the Bitcoin Fear and Greed Index fell to 10, I saw a screenshot somewhere to 6. I don't know if that's true or not, but at least we know it was definitely 10 on November 15th. That level captured the mood absolutely perfectly. That single reading sits inside a category in the index that's labeled extreme fear. That level is rare. Since the tool went live in 2018, it has only dipped to 10 or below on 40 days out of more than 2,800 days in total. That equals about 1.4% of the time. When you see this kind of reading, you know you are sitting in one of those emotionally stretched moments where the market feels like it has no floor. Here is where the history gets interesting. Binance Research went back through the biggest panic prints and asked a simple question. What did Bitcoin do over those days? On average, 7 days later, Bitcoin showed a 10% gain. 15 days later, a gain averaged around 7%. 30 days later, around 10% again. The recent drop already broke that short-term pattern, which shows how intense this move has been. But the longer-term picture still very much matters. These fear spikes often show up close to exhaustion rather than in early new downtrends. Now, guys, I want to bring up one more signal because it helps paint the full picture. The monthly return heat maps from CoinGlass show how Bitcoin behaves after deep red months. November 2025 is tracking as one of the worst November performances on record, down more than 20% so far. When you look at the full heat map, you see a rhythm. Those deep red months often sit next to strong green months that follow right after. It looks chaotic on the surface, but that pattern keeps repeating. So here is a message I want you to take from this part. We have Bitcoin in a classic correction range. We have sentiment sitting at a fear level that shows up less than 2% of the time. And we have a monthly return profile that has lined up with rebounds many times in the past. It does not remove the uncertainty. It simply shows that moments like this have often been turning points instead of endings. I mean, one thing about the fear and greed index is typically whenever we hit extreme fear, it's usually a good time to buy. Now, a couple of caveats I'll say. Again, none of what I'm saying here is financial advice. It just has been what my observations are of real data, plus what I've experienced myself and what I've noticed. But they often are. And if you guys watch my channel often, you know that I believe that this is not coming. We're not coming into the end of the bull market. I just think this is a correction phase. So typically it is a good time to buy after, but maybe not immediately after. We have to feel this out. I also believe that we're not going to really have a big, strong catalyst to drive a lot of money into the market until we get some more clarity around things like Clarity Act. If the Fed actually continues to lower and has a dovish meeting on the 10th, and then if nothing else is really super bullish, we probably get, in Q1 sometime, that new liftoff. That's just my overall thoughts there. Okay, now let's shift into the macro picture because this part sets the foundation for everything that comes next. While most people were staring at the Bitcoin chart, the Federal Reserve stepped into one of the biggest pivots we have seen in years. At the October meeting, they cut rates by 25 basis points and confirmed that quantitative tightening will stop on December 1st. And also, like I just said before, hopefully we understand what the mood is from the Fed, right? With the new data that they finally got and unemployment not looking great, etc. So quantitative tightening is basically the Fed draining liquidity from the financial system. When the Fed shrinks its balance sheet, it removes the cash that keeps markets running smoothly. Crypto has felt that pressure for almost 2 years straight. But somehow we still miraculously had a bull run up and to the right. And those probably were very much narrative-driven things like the ETF announcement, the ETF launch, the crypto president, etc., etc. And then you've got Binance Research that says the October drop was a forced pivot, and that matters. Liquidity stress started piling up everywhere. Here's the simplest way to picture it. Imagine money flowing through the economy like water through a city. Quantitative tightening was a Fed closing valves one by one. Now add the shutdown into that situation. Government spending just froze. but debt issuance continued. That combination pushed the Treasury General Account, which works like the government's own checking account, from around $300 billion to more than $1 trillion. That move drained another $700 billion from the system in just a few months. As that happened, bank reserves slipped under comfort levels. Repo markets started flashing stress signals. Foreign banking desks ran lean on cash. The Fed saw all of this happening at the same time and decided it could not keep tightening into those conditions. So they set an end date for quantitative tightening and prepared for what comes next. As Binance Research outlined in a two-step transition that follows from here, step one is what they called the TGA Slingshot. Now that the situation is over, the Treasury will begin spending down that $1 trillion pile. Each dollar that leaves the TGA flows back directly into the system. In the past, whenever the TGA dropped by more than $80 billion in a month, Bitcoin often saw gains during that same period, averaging around 8 to 9%. Step two, when the Fed likely begins what some analysts describe as QE light. This means the Fed could eventually start buying short-term Treasury bills again, somewhere in the range of $20 to $40 billion per month, to make sure bank reserves sit at healthy levels. The Fed will frame it as a technical adjustment rather than a full-blown stimulus program. But for markets, it's the exact same thing. Liquidity begins expanding again. So here's the real signal hiding under the fear. The biggest macro headwind for Bitcoin and crypto, QT, has reached its final chapter. The next phase involves the TGA spending money back into the markets and a balance sheet expansion cycle building up in the background. When you step back, you realize we are standing right at the edge of a major liquidity transition. And this is where this is literally the thing that, like, if anyone looks at this stuff, then I just don't understand how they think that we can actually be heading into we are in a bear market, and for the next 12 months we're going down only. Like I just, none of that makes sense. We've gone over this on the channel before. I'm going to do an in-depth video on this probably next week, but it's just crazy. We're about to see massive policy change. Whenever the Fed does something like this, I remember just how fast it changes in the market. I saw in 2019 when QT ended and the liquidity wave that followed caught people sleeping. These pivots rarely look dramatic in the moment, but they usually end up being the spark for the next big move. This is why, in my opinion, I believe that we're not going to see any, in my opinion, we could, and hopefully we do. We're probably not going to see a huge rally anytime soon. What we're likely to experience, potentially, is a little relief rally from the 80,000, maybe up to somewhere in the mid 90s or so, and then probably go back down for a while. Not sure exactly where we'll land. I hear a lot of people say like 70K or something, all-time highs. But in my opinion, this is definitely a manipulation by the people that want your Bitcoin. Do not sell your Bitcoin to the banks and the institutions that really want it at such a low price. I mean, don't ever sell your Bitcoin is my personal feeling. But anyway, this is a lot of manipulation right now. All of the tailwinds are extremely bullish, especially going into next year. All right, now let's shift into something that almost no one in crypto has fully absorbed yet, even though it's already live. The Genius Act rewired how the United States finances itself. And the change happened quietly, without any big headlines. Shanaka Pereira called it a treasury coup. And once you see how it works, the name makes sense. The law takes 47 pages to explain something very simple. Every regulated dollar stablecoin must hold 100% of its reserves in three things: FDIC-insured cash, short-term U.S. Treasury bills, or overnight repos backed by those same T-bills. Nothing else qualifies. Picture how this works in real life. Let us say someone in Argentina wants to move their savings into USDC, or let's just say the dollar. They sell pesos, they buy a digital dollar, and the issuer, Circle or Tether, now has to take that money and buy a treasury bill with it. That's not optional. It is mandated by law. When the act passed in July, the stablecoin market sat around $200 billion, and today it's roughly $309 billion. That means $109 billion of new stablecoin demand flowed straight into treasury bills over the last 4 months. Pretty wild, huh? Every digital dollar minted becomes a forced purchase of US government debt. Treasury Secretary Scott Bessent projected that this market could grow from $2 to $3.7 trillion by 2030. And that size, stablecoins would sit right behind the Federal Reserve as one of the largest holders of US debt. That is an incredible shift because the capital comes from regular people around the world looking for a safe dollar, not from a central bank printing new money. Shinaka describes it as privatized quantitative easing. And that phrase captures the idea very well. Private capital ends up acting like a constant liquidity pump for the US government. There's data to back this up. Researchers at the Bank for International Settlements looked at stablecoin flows from 2022 through 2024. They found that every $3.5 billion of stablecoin growth pushed short-term treasury yields down by about 2.5 to 5 basis points. At a $3 trillion scale, that relationship could suppress yields by 25 to 50 basis points and save the government more than $100 billion per year on interest payments. So here's what that means for all of us in crypto. Stablecoins have become a structural buyer of US government debt, and that means the world as well. This creates a steady bid under T-bills that did not exist a year ago. There is another side to this, and it matters as we look at the full cycle. The BIS study found that inflows lower yields gently, but outflows push yields higher at 2 to 3 times the speed. So in a deep crypto winter, when many people exit stablecoins at once, issuers would have to sell huge amounts of T-bills to meet redemptions. That would push borrowing costs higher quickly, and the Federal Reserve would likely need to step in to stop a funding crunch. So now that we have a clear picture of the environment Bitcoin trades in, QT is ending, the TGA release is coming, QE Lite sits ahead, and brand new structural buyers of treasury bills exist through stablecoins. All of these forces shape liquidity in ways we have not seen before. It helps explain why this year's volatility feels different. The system underneath Bitcoin is changing at the same time. Bitcoin goes through its own cycle. I mean, guys, I still feel like a stablecoin is eventually going to be the same as a CBDC. Probably not good idea in the long run to be securing all your value on a stablecoin. Better to hold it in Bitcoin, trade in stablecoins, whatever. But by all accounts, from the US, it was a genius idea. They didn't invent it, but it was a genius idea for them to push it and adopt it because now the world is buying the US debt. All right, guys, now let's shift to the part of the story that explains why the drop felt so heavy this time. A few groups became forced sellers at the exact same moment, and those flows hit the market like a wave. One of the biggest sources of pressure came from the Bitcoin ETFs. These funds were a major reason Bitcoin surged to new all-time highs. And the same structure can push the price down when outflows hit. CoinShares reported 1.94 billion of crypto fund outflows just last week, bringing the 4-week total to just under 5 billion, the third largest outflow run since 2018. Bitcoin alone saw 1.27 billion leave the space last week. When an ETF sees redemptions, it has to sell the real Bitcoin it holds. It is mechanical and large enough to move the spot market. At the same time, digital asset treasuries were under real stress. Decrypt reported that Bitmine, Metaplanet, and SharpLink together sit on roughly $5.8 billion of unrealized losses in their crypto holdings. Their stock prices dropped far enough that the market value of the company fell below the value of the crypto on their balance sheets. That setup squeezes them. Raising new capital becomes harder, and some boards start selling coins to fund operations or buy back shares to defend their stock. These are not emotional decisions. They are balance sheet decisions that can lead to selling at the wrong time. Matt Hogan laid out a simple framework for how these treasuries tend to trade. Investors discount them for 3 things: the delay before you can access the crypto they hold, the ongoing expenses of running the company, and the risk something goes wrong inside the business. Only a few treasuries manage to grow their crypto per share over time. And those few, well, I believe that they will trade at a premium. It's just a matter of the price goes up, right? But many will trade at a discount. And during drawdowns, that discount can widen a lot. And that pressure has now shown up in the market, in the price, and in the derivatives markets. QCP pointed out that long-term leverage has mostly been flushed out. Funding rates turned negative across the venues, which means short-term traders began paying to stay short instead of long. When that happens after a steep drop, it often reduces the risk of another liquidation wave and sets up the conditions for a rebound. It does not time the bottom, but it helps to explain why the selling started to slow down. While those sellers were rushing for an exit, a different group was quietly stepping in. Central banks began opening small test positions in digital assets. The Czech National Bank purchased Bitcoin and other crypto assets as a part of a pilot program to learn how tokenized reserves operate. New ETFs linked to Solana also launched and started gathering interest even while the broader market sold off violently, including Sol itself. Fidelity, Van Eck, and Canary all brought new Sol products to the market the same week. Bitwise Solana staking ETF saw steady inflows from launch with 0 days of outflows. That shows early demand for chain-specific exposure and staking yield. So the picture becomes much more clear. The short-term sellers came from ETFs redeeming, which is mostly retail, treasuries managing losses, and trades caught on the wrong side of leverage. The steady buyers came from stablecoin demand, central bank pilots, new ETFs, and builders who keep expanding the rails under the industry. When those two forces collide, the price shows the stress. Over time, the group with the stronger foundation tends to shape the next phase of the cycle. And, for me, I actually believe that there's a much larger picture here at play. I think that what has happened has been a highly manipulated market with people with way more money and more ability to easily manipulate the price and essentially take the money that you're gambling with, know where your liquidation point is, push the charts to that level, and then take your money so they can buy more Bitcoin. And I'm not talking about the market makers that we talk about every day. I'm talking about much larger forces, if you know what I mean. Not saying that's true. I'm just giving you my opinion. And also, guys, I think according to the whole DAT situation, I think that there's going to be a lot of M&A. These smaller DATs who started way too late are likely to be acquired by the larger ones or public companies where they can buy the entire public company with all the assets in the portfolio for less than the cost of the assets themselves. So they're buying these Bitcoin, ETH, Solana, for example, at a discount from market value. I mean, that seems like a no-brainer. All right, guys, now let's take all of this data and look at where Bitcoin could be heading. This is where the picture starts to make sense. When you pull up the historical charts from Charlie and line them up with past corrections against the recoveries that followed, a pattern shows up. Every major drawdown off a new all-time high eventually climbs back up and pushed beyond it. Some recoveries took months, others took longer, but the rebound always outweighed the drop that came before it. From 80,000 back to 126,000, Bitcoin would need to climb around 57%. Moves that size have appeared many times throughout Bitcoin's life, and this time is likely to be no different. Now, layer in the sentiment side. We just moved through an emotionally extreme point that rarely shows up, around 1.4% of the time. These readings do not time the bottoms perfectly, but they tend to show up close to moments where the selling pressure starts running out of fuel. You also have the macro cycle setting up in the background. The shutdown delayed jobs and inflation reports. The market spent weeks trading without any anchors. Once those numbers land, expectations around rate cuts, liquidity injections, and QE light will start shifting fast. The Fed already set the date to end QT. The TGA Slingshot sits right in front of us, and QE light sits on the deck for 2026 and eventually full QE. These are the conditions that usually feed the next wave of liquidity. On top of that, the Genius Act now funnels global demand for digital dollars straight into US treasuries, creating a steady source of debt financing that did not exist before. That structure changes how money moves throughout the system. It also gives the United States a new kind of monetary engine where stablecoin growth supports government borrowing without tapping traditional buyers. The strategic Bitcoin reserve at the Treasury adds another piece to the puzzle by giving the government its own hedge against long-term consequences of this new architecture. Because also a huge kind of hello moment should be the fact that the IRS is now going to accept tax payments in Bitcoin, and they'll even forego capital gains if you do that. At least that's what's being proposed on the table right now. What does that tell you about the long-term plans for the US to acquire Bitcoin? I mean, for all we know, they could be doing it quietly in the background before they publicly make it law that they're going to start buying it and these kind of things. You know, if you really wanted to own a massive supply, and that was your plan, you wouldn't tell the world and then go start acquiring Bitcoin after everyone else front runs you, right? But the IRS thing, the Bitcoin for America Act, so it's just these new kind of announcements that we have coming out should reinforce the direction that Bitcoin is headed in. So when I look at the next year or two, I see two cycles moving at the same time. And when I say the traditional Bitcoin cycle, I don't mean the 4-year cycle. I don't think that's intact anymore. But based on that, whenever we see these huge corrections, it's usually a big setup for the next run higher. And then we have the liquidity cycle, and we have the headwinds that turn into tailwinds as the TGA releases cash and the Fed prepares its next round of balance sheet support. Short term, we're likely to still see volatility. ETF flows can swing, traders can overreact, charts can whip around, which they likely will, but the deeper forces shaping this market look like they are setting up the next expansion phase rather than closing the book on this cycle. When the crypto data drops and liquidity switches direction, Bitcoin usually responds faster than anyone else expects. You know, even if you're like hardcore listening to TA guys, or you are a TA guy and you're watching Ben Cowan, you should really explore the liquidity side of what's happening, the macro side of everything, and check to see if what I've said in previous videos about the true drivers of previous Bitcoin bull runs, they weren't the 4-year cycle. Right? That was a coincidence lining up with kind of the business cycle, liquidity cycle, macro cycle, the fiscal monetary policies shifting from easing to tightening. Those have been the real drivers of the seasons. And I believe that this last bull run, if it was still intact, they say that history doesn't repeat itself, but it often rhymes, right? That's what people will tell you. I do a lot of TA. But tell me, what about this cycle has felt familiar to the last 4 years, the last 4-year cycle? I mean, 2021 felt very similar in a lot of ways to 2017, which in a lot of ways felt very familiar to 2013, for example. But this cycle, nothing really happened the same that it did in the past. So to look at one thing like the 50-week AMA or 200 AMA and say, oh, it's down below now, so therefore we're in a bear market because it lines up with every other 4-year cycle. But when you honestly think about it, what else has been the same this cycle as previous 4-year cycles? I mean, we can name a ton of things that weren't the same. We got all-time highs for Bitcoin before the halving. We haven't had really any new retail come in. We had a couple points at the end of 2024 where, you know, the Google searches for Bitcoin or altcoins went up a little bit. I mean, but it's nothing like last cycle. You tell me how your friends and maybe yourself are feeling right now. Like, has the cost of living gone up? Is it harder to buy groceries and pay for rent or your mortgage? Are your credit cards killing you? That's how most of the world feels right now, especially in America. I mean, but I'm sure everywhere else too. The fact is that in the past bull markets, we've had predominantly, those were driven by retail. And they were, their conditions were much different than they are today. And so we still had in a complete opposite monetary type of policy, often the ones that end bull markets we were going into. Those are typically headwinds like quantitative tightening, higher interest rates, these kind of things. that we need to see these parabolic runs and FOMO and retail mania. But now things are shifting, right? And so we're getting all those headwinds before, even though Bitcoin was rallying, switching now slowly into tailwinds. And I think that this is going to be a massive shift in a lot of people's minds. So when you think about the 4-year cycle and is it intact or not, I encourage you guys that if in the comments you want to let me know, because I have a bunch more things that don't make sense about the cycle that we're currently in. But in the comments, let me know below, guys. If you do believe that the 4-year cycle is intact, tell me all the things that happened that for you confirm that you still believe that the 4-year cycle is intact. I mean, yeah, again. So with that being said, and again, there's many more reasons why I believe that we have no idea what the structure looks like moving forward. My best guess, and I'll be releasing a full report on this soon that you guys can read. So stay tuned. But we could just be starting the real bull run. As far as if you believe in macroeconomics and business cycles and liquidity driving markets, then we could just now be at the beginning of this incredible bull run we've been waiting for. And I kind of stand in that camp. How long it lasts for? Well, it could be potentially 2 years or something, right? And things I've said in previous videos before were that I also really, really believe that everyone knows how important this midterm election will be late next year, right? And that is critical for the Trump administration to stay in office and be able to continue to have the least resistance on their path. Republicans control all 3 branches of the administration. If that switches, because sentiment around Trump's performance switches bearish before the midterms, then the administration is in a lot of trouble. So how do you make sure that everyone likes you and your party stays intact? Well, you give people free things. You make their living conditions better. For institutions, which are basically the lobbyists around all politicians, they want to be happy that the share price is up and that their portfolio is up. What do people who strive every day just to kind of go paycheck to paycheck, what do they want? Well, they want help out of the situation that they think was caused and are right by the government, and they want relief. They want free stuff. So initially, give them $2,000 check. Help them out a little bit. But I think there's going to be a lot more stimulus that goes directly to consumer leading into that midterm cycle. Not to mention everything else I've talked before about on this channel, things like the big, beautiful bill. That's $5 trillion in spending coming soon. That's going to flood the markets with liquidity. And also everything I've just talked about, right? The TGA, the interest rates are going to come down near zero. And so we could be looking at the beginning of 2 more years or so of upside. I don't know the answer to that, but I think it's very possible, right? I mean, sure, in those 2 years, we're likely to see big corrections and people, and it'll get scary and you'll feel exactly like you feel right now. But I think it's very important that, this is not my opinion, but I'm just saying I believe that to those who are kind of in control of Washington and the lobbyists and the companies who wanted this administration in office, I think it's important for them that this power structure continues and these laws that are being implemented continue, not just in crypto, but across all industries. So midterms, extremely important. And then 2028 election is very, very important. So I think along the way, there could be some pullbacks and they could last months. But I think at both those points, late next year and then the end of 2028, things need to be in good shape for those outcomes to happen. All right, guys, and before we kind of get to what all this means and where we're headed, I just want to give a big shout out and thank you to today's channel sponsor, which is NordVPN. You worked hard to protect your crypto and your data. Guys, said this before, don't be a dum-dum and let one bad click undo it. NordVPN is the first line of defense. It hides your IP, encrypts your data, and keeps you one step ahead of scammers and trackers. And here's a pro tip. Literally, I showed you guys when I did it before on a video. I saved over $300 on my last trip. Most people never realize they're being overcharged simply because where their IP location is or where they live. So guys, it's a no-brainer here. Protect your portfolio, unlock the full web wherever you are, and save while you're at it. There's a link in the description, guys. to get 4 free months and over 70% off. They cost less than a cup of coffee every single month, less than 1 cup for the entire month. How is that not so obvious? So don't wait for a hack or security breach or data brokers or whatever to reach you through leaked data, these kind of things. So guys, hit that link in the description to get up to 4 months free and over 70% off. Don't wait for the hack to learn the hard way. Use Nord like I do. Stay private, stay protected, and stay ahead. For years, I only knew how to make money while the market pumped. But now that's changed. So that's why I partnered with Blowfin, a global exchange with low fees and every trading pair you could want all in one place. So if you're looking for a great exchange to make your trades, just click my affiliate link down in the description below and get started today. Go check out that promotion as well. And guys, just so you know, full disclaimer, if you use any of my affiliate links below, I may be receiving a small commission from my partners. Plus, you'll be supporting the channel at no added cost to you, which would be really appreciated. So again, thanks to the amazing channel sponsors. I use them myself and believe in them. And now back to the show. Let me bring this back to you because all of these charts and policy moves only matter if they help you make better decisions. So guys, if you believe that Bitcoin is here to stay for the long term, and we've got more momentum ahead, a 36% drawdown with extreme fear and macro headwinds about to flip into tailwinds, this looks less like game over and more like the midpoint of the story. History shows that the biggest gains have often come after the ugliest corrections. When the fear and greed index hits 10, when ETFs puke out coins, when social media screams top, that usually has been where smart money begins quietly accumulating for the next phase. You don't have to nail the exact bottom. You just need to understand the part of the movie you're in right now. Right now, the data suggests we sit in a messy middle where price wobbles, liquidity swaps drivers, and headlines push people out of their positions. So my view stays the same in one way and steps up in another. I stay long-term bullish on Bitcoin into 2026 and possibly beyond. And I now see this crash as a point where old liquidity regime based on QT and fragile debt markets gives way to a new regime where stablecoins, QE Lite, and digital rails define how money moves. If you can zoom out and see that shift, every scary wick on the chart looks a little bit different. The volatility becomes the sound of a new market booting up. So guys, stay sharp, manage your risk, keep learning how these macro prices fit together. And if you still believe in where the space goes over the next 5, 10, 15 years, keep stacking in a way that lets you sleep at night. It's very important. So remember guys, stay sharp, keep stacking those sats, and I'll catch you guys on the next one. See ya.